Welcome to the Broken Pie Chart Podcast, episode 348. I'm your host, Derek Moore. With me once again, Shane Skinner and Mike Snyder from Zega Investments. Guys, how you doing today?
Doing
Mike,
good.
how are you doing? I guess I got to say who I'm talking to.
Didn't want to talk over anyone. I'm doing good. Doing good. It's a nice Friday afternoon here. So how are you?
I'm all right. Shane, I know you got a big week coming up with Halloween and everything, but volatility is dropping.
Yeah, I mean all-time highs today, right? At least in the S&P 500. Last time I checked, we broke above 6,800. Seems like market was pretty satisfied on no real news or anything shaking.
Well, we got news today. We'll get to the inflation stuff, but we got it today.
So what I mean by that, I guess, is that nothing unexpected happened. We got the news that we were expecting to get, and that was that. And it didn't seem to, I don't know. We'll get into that, but it seems like inflation expectations weren't terrible, which is great.
Mike, I don't know if you saw the CNN Fear and Greed Index. So that's a amalgamation of a bunch of different inputs. It showed fear, even though we were at all-time highs. And somebody made the mention on Twitter, like, this is really odd. I looked at it, and some things that were showing fear, I don't think made sense. Like if your momentum is below a moving average, and it was actually above. But I mean, we talked about it last week, Mike, where we said, I think the VIX is maybe a little bit too high based upon where the market is. I mean, a week ago, we were over 25, and that's just collapsed.
Yeah, I mean, I think we've seen tariffs have a big short-term impact on the market. And, there were concerns about, tariffs last week. And I think it may have spooked people again, after what happened in April, even though the market recovered and then some. We saw how it initially reacted, and that could play a part in it.
Well, I mean, it's the taco trade. We threatened big tariffs on China, and within a week or two walked them back, even said they weren't sustainable. So, it's an interesting situation where the president of the United States word has that much of an impact on markets, but that's not saying good or bad on him.
It's always what he does, though. I mean, he goes...
Right, and people who haven't recognized that by now, I don't know what to tell you. It's pretty easy to read at this point.
Well, I mean, the market in April didn't recognize... I mean, they didn't believe him. He's been saying forever, I'm going to do tariffs, and then he did it in April, and the market acted like it was shocked. It's since recovered, but... I mean, I'll tell you this, too. Some inflation data came out today. It was basically 3% year over year. Core and regular CPI. Core, of course, is X food and energy, which are considered more volatile. The regular CPI, they're both basically 3% year over year. And I thought I'd take a second just to go over these, and the three of us can talk about it. If I look at the CPI and what was driving that, 3.013, and then core services of that, 2.099 was responsible for, or the core services were responsible for 2.099 of that. So 3.013 minus 2.099, if I'm making any sense, that gets you what's left. 61, almost 61.5% is the weighting for core services. Core goods only went up year over year, 0.315%, food, 0.423%, energy, 0.176%. And then, of course, the core CPI was 3.019. And then you look at services and you say, well, what's driving services? Because core services, and we just mentioned, they were up the most. It's shelter. So of the core services, 59.48% is weighted to shelter. Shelter is 2.099. So when you look at this, and the reason why I'm bringing this up, all the talk was tariffs going to drive massive inflation. And that was the wrong trade. It hasn't. And sure, some people could come in and say, well, they've backed off or they've made adjustments or allocations or they've exempted some things. I mean, the market is discounting all of that information. But when you look at this, inflation just has not materially caused any real effect on inflation. And then you look at, let me go through this and then we'll kind of discuss this. This was a graph. I think this is from Bloomberg. U.S. inflation cools unexpectedly. Smaller gain in CPI keeps Fed on path for interest rate cut, which is where everything navigates to. But you look at the month over month numbers, and this chart goes back to basically September of 23, maybe August of 23, right around there. Month over month change in consumer price index. We're not higher on a month over month basis than we were in 23. Change in CPI ex food and energy. We're lower than where we were in September of 23. Change in goods prices, ex food, energy, month over month. We're higher than we were September 2023, but it's not crazy. And change in core services prices, ex housing. And, we're sort of lower than we were in 23. You look at all of this and you say that those that were betting on massive inflation because of tariffs, the trade has not worked out. Shane, I'm going to come to you first. I know sometimes the most obvious trade isn't the one that works. And this isn't something at Zega we're making a trade on. We don't trade on this stuff. We sort of buy and hedge, buy and buffer, do a lot. We have a lot of different stuff besides that. But Shane, you look at this and the most obvious trade in history, it seemed, was wrong.
Yeah. Realistically, I think what happened, the tariffs are not, we've seen this before. I think President McKinley was really big on them like 100+ years ago. But markets hate uncertainty. And I almost wonder if this tariff thing was so, we haven't done anything like this in such a long time that no one really knew what to expect or what would come from it. And so I think market's initial reaction, like we saw March, April, was just the huge sell-off. Implied vol and realized vol were not nearly lined up the way they normally are. And, since April, we've seen one of the most spectacular rallies, I would argue, in a single year in the market's history. Maybe you could say COVID was similar in terms of just big sell-off in a small time span and then rallied hard. But, I think the market was just scared of something it didn't understand initially. And now that we see that it really hasn't caused that much of an impact on the data, on the consumer, it seems like it was an overreaction from the market this spring.
Mike, we've been talking about this for a while, and I was trying to think of the most obvious trades that never happened. I don't know if you can think of any ones off the top of your head. But, Shane mentioned the market does not like uncertainty. I think I talked at and during the open, the market didn't believe that he was actually going to put tariffs on. He put tariffs on. The market miscalculated there. So is the market is the next trade that could or couldn't be wrong? And I'll let you know when I know, is the idea that we're in a bubble. I feel like everyone's been saying the market's too high, the market can't go up. And as we've been kind of joking around, Mike, it's like, just shut up and take the gains. Sometimes markets just run for longer than anybody expects, right?
Yeah, especially when you have innovation like we're seeing right now, with AI being adopted, faster than really any other technology we've ever seen. There's a lot of momentum behind that, obviously. And getting back to inflation, I think if you still, if you go on the street and ask people, everyone's going to say things seem too expensive, but the numbers are showing that it's sort of just sticky at this number here at 3. And some will argue, well, that's above the Fed's target. And so inflation still needs to come down. I don't, necessarily see that happening. And I think the fact that it has seemed to stabilize at this number is the reason why the market, and we'll get to this in a little bit, I believe, but why the market is pricing in these rate cuts, because it seems like inflation is not really moving.
I mean, when people, and I agree, when I talk to people who are not in the markets and don't follow this stuff, they're like, I can't believe how much prices are going up. I can't believe. And really what they're reacting to is it used to cost $1 and now it costs $2. Like what they don't understand is the prices always go up, but the rate of change goes down. It slows. So if I go back here, I'll pull this up really quickly. I'll do this on the fly. So if we look at May 2020, the CPI, the index for all urban consumers, all items, was 255,802. So that is, let me see, how long ago was that? I mean, it's June, July, August, September. It's a little over 5 years, right? And the all index, so the index today, the last one that came out, which is the September one, was 324.368. So if you look at this and you say, well, how much are prices up on a cumulative basis according to this? Prices are up 27%. Inflation could slow to 1%, but prices are not going down. It just means they're going up less. So, yeah, I mean, I think there's this misnomer about it. But what about the markets? I mean, see, I remember in 98, like the late 90s, people said the markets can't go up. They can't keep going up. And they did. Like markets do this, Mike.
Especially when people say that they can't. It seems to be the time when you continue to grind higher is when there's a lot of doubt. It means there's probably a lot of money on the sidelines still, which could drive the markets higher once people eventually do buy in.
Shane, we talked in April, and not like anybody can pick the low, but I mean, you remember this. The market was at 49 something. It had a 49 handle in front of the S&P. And there were investors we talked to, there were advisors we talked to who were thinking, well, I'm going to wait and see if things get better first before investing. Like they could have bought at 4,900 or 40, just below 5,000. We're not suggesting you time the market, but it is interesting. People don't want to buy now, but they also didn't want to buy then. Like they're never quite comfortable buying. Like when is the most comfortable somebody can buy?
So I love that you bring this up because realistically, like you have to take a risk in markets, right? Buying means you're taking a risk. We like to buy and hedge, so we manage some of that risk. But I think that there is so much noise out there. There's so much. Our brains try to make sense of markets in ways that aren't always right or accurate. I mean, we've talked about this many times. I've been concerned of a pullback in the market, and you and I will sit down and talk, and after 20 minutes, I'll come to the conclusion, oh, maybe I shouldn't be as concerned as I am. But, realistically, I don't think I've ever been in a market where I've heard of or seen this many people speak so negatively or so bearishly or just don't have any desire to, like you said, get in up here. They didn't really have a desire to get in down in April. And, at some point you've got to get in, right? And to go back to April, I think it was Warren Buffett who said, like buy, right? When no one else is buying, that's probably a good time to buy. Something of that extent, I think he's quoted with saying. And, it makes total sense in retrospect. In April, a lot of people saying, oh, it's the end of the world. We're not going to recover from this, blah, 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 blah. And those who were willing to step up when no one else was and put some risk on have been rewarded handsomely since April. And I don't think that at this point anything's going to necessarily shake us back up and send us back down in a manner like that anytime soon. The only thing I can think of is a major liquidity risk or issue that pops up. And I'm not going to go down that rabbit hole right now because that's for a later podcast.
I mean, you know who did well? People who just have a 401k, don't look at it, and never make any adjustments. Like
Exactly.
Mike, that's like those people. The reason why 401ks work is because those people are not trading. They're just putting money in month after month after month. And then they look back after 20 something years, 30 years of doing 401ks and like, oh, wow, this actually works. Like that's kind of the idea. I mean, trying to pick markets and time things, it's not great. I mean, I don't know if probably not going to mention when we have a couple strategies that have gold, and I will tell you, Mike, I've shared this with you. There's some people said, oh, maybe I should add those after gold's up, 50%, 70%, and 30%. I'd have to look at the numbers. But, rotating, it's like people bought emerging markets in 1998 or 99. I forget what, they were up 70 and then they weren't the best. But those, Mike, are the people who do really well. Just sit on their hands, invest over time. Like it works.
Yeah, there are stats out there, and I don't have one in front of me, but it's not only are the more active traders worse off in terms of returns, but also like the people that look at their account more even are worse off than someone who doesn't even pay attention. And I'm not saying you shouldn't pay attention, but that's the idea here is that your odds of missing gains in the long run, whether the market is selling off and volatility is high or we're at all-time highs, the odds of missing out and going to cash and picking the right time to get in, the odds are not in your favor of doing that. And it's a psychological thing, right? Like it's scary to invest when the market is selling off significantly and there are fears that the market could continue to drop and this is the next 2008. And it's also, you don't want to buy in at the top and feel stupid if it sells off and you bought in at the top. But the odds are, even if that does happen, you're probably going to be better off in the long run having bought in at the top because the market continues to make new all-time highs.
It's almost like the worst thing that happened was 2008 because people have spent the last, how many years is that now? Is that 20? No, it's not 20 years. That's the last 17 years trying to predict when the next 2008 is going to be. And as Peter Lynch would say, more money has been lost preparing for recessions than in actual recessions. So all right, let me go bearish for a second. Like the bear case here always comes back to earnings. We have a couple of really big companies reporting earnings next week. Apple, Meta, they're kind of big, right? I mean, they're big companies. You got Microsoft, I think they're kind of big. Heard of them? Google. So you've got these companies who are reporting next week. Like to me, if these companies start to disappoint in earnings or say something on a forward guidance basis, and those earning estimates have to come down, like that's the bear case. And that's why, we hedge and we buffer and we do things like that. I want to go through, let's start with Apple. When I grab this screenshot, it's right around 263 and change, 263.31. I don't know where it actually closed. So they have earnings next week. If I look at the October 31st, so the Halloween, very spooky week for options traders, not really, but it kind of is. All right, so 262.50 is the closest strike. The implied volatility is that right? It's only 36.5 basically. So 36.5 is not that high of a volatility relative to some of the other ones. So I'd have to look at the other ones, but I don't think anybody's got lower volatility. So the expectation for a move, 37 still for Apple is probably higher than the back months. But okay, if you look at Microsoft, so they're October 31st, and we're doing the October 31st because it includes the day that they report earnings. Some report on Tuesday, some on Wednesday. I think there's somebody on Thursday. Microsoft ended right around 525. Nicely enough, there's a 525. The implied volatility is 43. You go to Meta and close right around 738, 739. Let's use the 740, a little bit higher, 63% implied volatility. And implied volatility, of course, informs as to how rich or robust options premiums are relative to one another. And finally, Google right around 260, the 260, just under a 60 implied volatility.
Did you intentionally stack these in order here in the list to be
No, I didn't.
smallest to largest? That's funny. I'm gonna make a bold claim here. I think that the implied vol across these names is indicative to just how much AI exposure that company has. Apple, I think, is the least exposed to AI in terms of its existing growth and future projections versus Microsoft, which is less, versus Meta, which is less versus Google. Maybe I'm right, maybe I'm wrong.
I mean, maybe that's the case. It's still like when you look at Meta or Google, because I arrange these charts a little differently. So Meta is a good example. Meta, what did I say? The 740, right about a 63% implied volatility. 21 days later, that same strike is only a 43, 44. So there is increased volatility, meaning the options market is expecting a move based upon the earnings. We'll see what these are. The real way to do is just kind of look the day before. But maybe it is looking at AI. I mean, the other fly in the ointment here is that all the CapEx spending goes away, and there is some cross spending between all of these companies. But Mike, I mean, when you look at this, are you surprised that Apple has the least? Were you thinking that these should be higher? What are your thoughts here?
No, Apple seems a little low, but the way it's traded, the last few years, even, I think it makes sense. It's become less volatile. Microsoft was in that space sort of with Apple at one point where it also was less volatile, but it has since gotten more volatile again. So these seem right. These seem like what I would expect.
So if you bought the straddle, meaning buy the call, buy the put, same strike, same month, we're going to go October 31st, which is the 262.50. It costs you roughly $11. So your break even is about 273.50. That's up or down. That's on the upside. On the downside, minus 11 is what? 251.50. So 251.50 by 273.50, and the stock closed right around 263 and change. I mean, it's got to go up 11 points just to break even. Is that a good trade? I don't know. I'll let you know when it reports earnings. But
it's like a 4% move.
Like that seems low what it's pricing in, but maybe it kind of feels like everything is built into the stock. Like maybe they've done a good job guiding. I don't know.
I would have expected at least 5%. Just anything at this size, this magnitude, I would at least think 5% in every single one of these names would be being priced in. So that does surprise me. I'm not saying I'm going to go buy that straddle. I'm not. But
you're selling it then. I got it. Okay.
Absolutely not. I'm going to sell an iron fly, maybe.
No, you're not. Okay. So, Shane, but we talked last week about Intel, and we were surprised that Intel had higher implied volatility than Netflix, right? Wasn't that what we found?
Yeah, absolutely.
And the market got that right, it seems like.
It did, yeah. Intel had a big move up, sort of faded back down, but yeah, moved up quite a bit from earnings to its highest price of the week. Um, I fall back on, look, the government has about a 10% equity stake, I believe, in Intel at this point. So, I think the market's maybe going, hey, maybe there's some news guidance or information that we don't really know of because of that stake that the government has. Um, but I mean, they seem to have gotten it right. It moved quite a bit.
So I'm just looking at Apple's forward PE ratio over the next 4 quarters. Let me see if I can find this. Price to cash flow, price to EBIT. I mean, it's like 33 times next 4 quarters. I'd have to look and see where that is relative to history, but I mean that's if you're taking a bear case on this market, you think these companies, they're not going to guide well. You think even on a valuation basis, like earnings estimates could stay the same and they could re-rate the multiple on these, or this capex spending, which some people have argued is going circular around one another, is going to go away. I mean, it's I don't know. Google to me, Mike, was like I felt like that could they had some risk of their moat being disrupted just because of ChatGPT. Like, are people going to ChatGPT? Although now it seems like with their Gemini, like I don't know if you've done a search recently, but when you do the search, it gives you the AI summary, and then you can click on the links within there. Maybe they're going to be smart about this and they'll figure out how to really monetize that. I don't know.
Yeah, I'm looking at their PE too. It seems to be, on the a little bit cheaper than some of these other names. So maybe the market is still a little bit worried about that. It's trading at forward PE of 23.75, so a little bit cheaper. But yeah, I mean, it seems like they have figured it out in the search aspect of things. Every time you search something, you get their AI response.
I wonder what YouTube, if they just branched that off and made it its own company, what that would be worth. Feel like that's not getting disrupted. Like, that's a juggernaut.
And people have tried, and it doesn't seem like that's where the creators want to go, and that's where the creators go, the eyes go. So,
Yeah. Shane, all right. So if we come back to earnings, I mean, so far earnings have been pretty good. I think they've been beating, although I don't know that the beats, the spread between the estimates and the number has been as wide as previous quarters. And maybe they were beating too much. So the analysts just kind of said, well, I'm going to adjust my earnings a little bit here. I'm going to put a beat premium on it. But I don't know. Shane, any thoughts before we move on to something else?
No, I mean, at the end of the day, I focus less on analyst expectations and more so, like you said, we look at total, expected growth of earnings per share and the profit margins. Look at the stuff that actually matters. There's a lot of analysts with a lot of opinions on what stocks are going to or not going to do. At the end of the day, it comes down to the real, numbers that the company produces.
Shane, I'll ask you this first, and I'll ask you, Mike. Like, in the '90s, it was a lot different. So I'm going to ask you that. Do you know what the top analysts are on some of these companies? Do you even pay it? Do you know when they change their target or they change their expectations? Are
If
you even aware of those?
if I have the news section of the trading software I use pulled up and it's on a stock that has one of those, adjustments come out, then I'll see it. Maybe if I see it on CNBC. Um, Otherwise, no, I typically don't. And I more so like to go through financial statements myself and read go to the actual company website, do that research myself, than just trust an analyst. Not saying analyst reports are bad or erroneous, but I think we like to fall back on, hey, you should probably do your own research. Don't just take my word for it, right?
Mike, if I asked you who the top analyst is on Apple, Nvidia, would you even know? And I'm doing this to prove a point.
Yeah,
So it's
no, I don't know, and don't really care either. I mean, they serve a purpose. I know people follow them, but I don't know a more effective way to look at where the market sees a stock going than to look at options, right? If you believe that markets are efficient, and I believe they are, then looking at how options are priced and where the market essentially thinks that the stock could go based on how the options are priced, that's really what's important to me, regardless of the stock. I don't think that I'm going to be able to find something in a financial statement that's going to say, I think this stock is undervalued, that the options aren't already showing.
I mean, with technology too, and this is why I kind of think sometimes value investing doesn't work anymore. And sure, maybe it will, maybe it won't, but it just hasn't. Momentum's done a lot better than value. And it's just people used to have an edge being able to go through those financial statements back in the day, and if they were doing it better than anyone else, or they put the time in, they could get an edge. I don't think that edge is there anymore because the information's all out there. I think it's a good point about the options market too. But
I would also argue that we don't have the same type of mindset of investor as we did 20, 30, 40 years ago. People seem to be more open to investing based on financials, like basing their investment decisions on that. I don't think that's how majority of market participants operate anymore. At least enough of them to the point where it's having an effect on markets where, again, like you said, momentum outpaces value.
so the reason I asked you about analysts is because it was a big deal in the 90s. CNBC, so it was Joe Kernan, uh, the guy who passed away. What was his name? Mark
Haynes.
Mark Haynes, yeah. And the guy who's on with Kramer now with he's got the dark hair. What is his name? You can tell I don't watch. David Faber, yeah. So Faber, Kernan, and Mark Haynes, they used to be the morning people. Like there was no Becky Quick, there was no Andrew Ross Sorkin. So if there were, I think it was over 3, maybe it was over 4 downgrades in one day on a stock, they would play like this video of penguins in Antarctica, like walking off an ice shelf and falling into the water. It was like analyst upgrades, downgrades were a big deal. In fact, they would move markets. So, yeah, I mean, I can tell you that I remember who an Intel analyst was. Kurlak. Was it Tom Kurlak or Michael Kurlak? I don't remember his first name, but he was a Merrill Lynch analyst, and he was like the number one analyst on the street for semis. So when he came out with something on Intel, it would move the market. So, I mean, it's one of those things where you guys don't even know who the top analysts are. And I remember one from the 90s on Intel. It's crazy. So I don't think they actually matter anymore. I'm just going to go out on a limb and say it. Like, you guys don't even know. You're in the markets and you don't know who the top analysts are.
Yeah, I mean, Mike, I don't know about you, but I think that the market now, while markets are always markets, the environment, the drivers of flow and decision making are completely different now than they were 20, 30, 40 years ago.
Yeah, I mean, Derek, I don't know what it was like in the 90s. I don't know what the types of calls analysts were making, but it just seems like anytime I do get a notification of an upgrade or a downgrade, it's after the stock has made some sort of move and the price is being changed based on where the stock is. I don't follow them enough to say that that's for every stock, I'm sure there are cases where people are going out on a limb and putting up big targets, but that just seems to be a reoccurring thing I come across.
I fell victim to a big target. There was I'm not going to name the stock. There was a stock trading at like $2-3 a share. Someone came out, said it's going to go to 10. And I said, oh man, this analyst, he must know something I don't. I'm going to lean into this position. And that thing got cut in half like 2 weeks later.
I just pulled up in an old, I did a search, and it's from August 22nd, 1997. Intel leads tech sector lower after downgrade by Kurlock. And it says Intel shares closed moderately lower Friday, recovering from an early plunge after Thomas Kurlock lowered his intermediate term rating on the semiconductor to neutral from buy. Yeah, I mean, this used to happen. That doesn't happen anymore. It really doesn't. So I also remember that, what was it? What was the, it doesn't matter anymore. I lost my train of thought. See that? I'm getting old. I can't remember stuff. So there you go. All right. Let's talk about mortgage rates. I had something really good to say about Kurlock and Intel. Now I can't remember it. Oh well. So the national bank rate average is 6.34% for a 30-year mortgage right now. And people have been asking, like, what would have to happen for mortgage rates to get down to 5%? And we've covered this a lot on this show over in the last couple of years. And the amount of interest or the rate of return that owners of mortgage-backed securities have been demanding has been higher. And because of that, you have this spread between the rate on the 30-year mortgage and the rate of the 10-year treasury. And 10-year treasuries is kind of a good, 30-year rates, mortgage rates are drawn off the 10-year treasury, and there's any number of reasons for that. My analysis of that is that most mortgage are not held for 30 years. They're held for a shorter term, and that more aligns with the holding period of most mortgages. But people said, how do you get rates to go to 5%? Well, the typical spread, and right now that spread is about 234 basis points. So 3.99 plus 2.34 gets you to 6.34, rounded. The median difference going back, it looks like about 25 years, it's about 174, 175 basis points. So if we were just at the median difference in the spread, we could take 6.34 minus the 1.74, and we'd say, well, if they just went back, if interest rates didn't change, or if the 10-year yield didn't move at all from where it is now, and it's rounded right at 4%, you would say that you take the 4% plus the 1.74, call it 1.75, and mortgage rate should be at 5.74, not 6.34. So if you just got to the median, if you got to the average, which is about 1.86%, they'd be a little bit higher, another 11 basis points higher. So what would it take to get to a 5% mortgage? Well, to get to a 5% mortgage, you take 5 minus the 1.75, and it says 10-year yield would need to be about 3.25% plus the normal or the median spread between the 10-year yield and the 30-year mortgage. And that's how you get to a 5% mortgage. You could keep the same spread as it is now, and rates could go lower. The spread could increase, and rates could be even lower. And by the way, mortgage rates can go up if the 10-year yield goes up and the spread increases. But people have been asking about that, and so I thought I'd spend a little time on that. Mike is someone, and Shane, but I'll go to Mike first. As a newer, at least homeowner in your current home, does this excite you, or does this I wish they would just go down already? I mean, does this make sense? Like how this is kind of set up? Like everyone's like, I wish rates were at 5%. Well, this is how you do it.
Yeah, makes total sense. Like you said, a lot of this right now has to do with the spread. If you expect that spread to come back to its historical median, you can figure out, pretty easily what you would need the 10-year to be for you to expect a 5% rate. So do I want them to go down now? Yes. But will they? No, not right away. I think it'll take some time for that spread to continue to close. I mean, it was higher back in 2022. We had a spread of 334 basis points, so it has slowly come down to where it is now, 234. But yeah,
Shane, I think, one of the things that's misunderstood by a lot of people too is if you're holding a mortgage bond, it's a different investment than just owning a bond. But if you hold a mortgage bond and you believe that on average, those mortgages, you buy a mortgage bond, it's a couple thousand mortgages wrapped in, all packaged together, reduce the risk, all that stuff. But as a holder of that bond, you're kind of like, well, I don't expect people to hold these for 30 years. So if I'm buying a mortgage bond and I'm getting 6.34% on average right now, but I believe that if rates go down, I'm not going to get to enjoy that 6.34 because everyone's going to refinance. And so I want to get a higher spread than I normally would to compensate me for what's called kind of the negative convexity of mortgage-backed securities. So Shane, first, any comments on that? And then I think you want to make the contrarian case here of why you think rates can go higher.
Absolutely. First, to comment on what you said, yeah, I think that I think people forget that just because something is a bond for 10 years, 20 years, 30 years, um, that doesn't necessarily mean, like you just said, that's how long it's going to exist before it gets, closed out, or it might get paid off sooner. Um, so there's all these avenues of risk or areas of risk when you have that long of a duration, um, in what you're sort of trading or buying or investing in, and those are things that might not seem obvious at the surface level, but when you really start to think about that, oh yeah, 30-year bond on average, or 30-year mortgage on average, is going to get closed out within 10 years because they're either going to pay it off or sell, move, do adjust. um, you, as someone who's on the other side of that, participating in the lending side, you have to factor that in, and you're not going to take less, in a situation where you think in the future you're going to get less. If that's the case, then you need more now. So that doesn't surprise me at all. That sounds logical.
I mean, imagine Shane in 1982 if you said, I can buy a 30-year treasury at 16%. I think it was there for a little bit, at least 15%. Or I could buy a bunch of MBS bonds. And the problem is, if you buy the MBS bonds, everyone refinanced in there, or they were just asleep and kept their 16% mortgage.
Absolutely.
Or you could have that 30-year treasury and enjoy the 16% annualized yield, for a fresh off the rack treasury. So to go to the mortgage-backed securities, you have to either believe that rates are going higher and you're going to get to keep your cash flow there, or you want to be compensated. So, I mean, that's kind of an extreme example. But all right, Shane, give me the bear. What's like the bear case? So somebody says, oh yeah, there's no way mortgage rates can go up. Like, be a contrarian for a second. What's the argument?
Happy to. I kind of mentioned it earlier. If there's a major liquidity risk within the plumbing of the sort of broader financial system, um, we just saw sort of this like weird freak out, 1-2 weeks ago, over regional banks that has since sort of subsided. Um, but you have things like that pop up, and things can get weird. You also have things that are really hard to price in, which are geopolitical risks. I don't see anything awful happening geopolitically at this time, to a scale or a manner that greatly hurts the financial system, but at the same time, anything's possible. So, um, I don't know. I can't solely just because they're cutting rates on the front end of the shortest duration possible. I can't fully buy that guarantees that back end rates go lower. It could. It probably will. But I don't take those as one for one.
What the back end should go higher if nominal growth is higher. So if you look at nominal GDP, if you're making the case that rates can go higher, then you're saying it's going to be a growth story. You're going to see nominal GDP grow. You're going to see it grow like it did in the 90s. And you would expect to have some spread between the nominal GDP growth, nominal meaning non-inflation adjusted. Like that's one of the cases too. It doesn't even have to be a bad thing. It could be a good thing. Like, oh wow, we're growing a lot. But that growth is going to be reflected in some of the bond yields. So, all right, it's not a bad argument. I'll let you know what I know. How's that? All right. Let's get to recommendations for the week. Shane, go to you first. By the way, I don't know if we talked about this on air, but Mayor of Easttown, you had never seen it. You watched it. Do you recommend it for the audience?
Absolutely. Buy with both hands as much as you can.
Conviction list, strong buy, pound on the table, right?
And fantastic. Some of the best TV I've seen in a long time. Not something I was able to predict. And I find that most things in TV or movies nowadays, I can usually predict it too soon, and it kind of ruins it for me. This one had just twists and turns like no other. There was one episode that ended in a manner where, I just sort of, my fiance and I sat there beside ourselves, just didn't really know how to process what just happened. It was so fast. If I had to give a recommendation outside of Mayor, it's going to be Finding the Money. Finding the Money, there's another side to the national debt. And it's about a group of economists that are essentially trying to flip our understanding and perception of national debt upside down. It kind of gets into modern monetary theory and policy. I know some people believe heavily in it. I know some people think it's idiotic and will never work. Regardless of what you think about it, I think it's an incredibly insightful view into why the people that support that theory and idea do, and they do a good job of explaining it. So, and I'm curious to know if you've seen it, and if you haven't, you should definitely watch it. I would love your take.
I have not seen it. Mike, have you seen that one?
No.
Where is that? So Mayor of Easttown is on HBO Max. Where, say the name again, and where is it located?
Finding the Money, and you can get it on Tubi for free, Roku channel for free, and then you can rent it pretty much everywhere else, Amazon, Apple, but Tubi's free. So, yeah, it's interesting. At one point, they are interviewing. It's someone within the economic cabinet of the Biden administration, and they ask him, "What is money?" And he can't answer the question, and gets visibly flustered. It's just, you got to watch it.
All right, Mike. Any recommendations this week?
Yeah, we're watching The Diplomat on Netflix with Kerry Russell. It's like a political drama. Third season just came out. I would say the first two seasons were very good. I'm only halfway through this one. So far, it's like barely a buy for me. So may want to watch Finding the Money first. Shane seems a little bit more enthusiastic about that one. This show's good, and I feel like I just got to stick with it and finish it out at this point.
Kind of sounds like a whole. That's where I'm on Chad Powers on Hulu. And I think my problem with Hulu, just in general, is just give me all the episodes. Don't make me wait. I just should have waited to watch it. It's what I do with Survivor. I know the season's been on for like 2.5 months. I just tape them all and I watch them all at once. So I think It's a hold recommendation on Chad Powers on Hulu. I'm sorry to say. It's I can't give my enthusiastic buy on that one. So it's a hold. Did I talk about Chad Powers last week? I forget.
It's been a developing story.
Yeah.
I think you were more of a reasonable buy early on, and since then it's faded into more of a hold.
High volatility in that name.
Yeah. I mean, I think that's right. A little bit of high volatility there from week to week. Next week is the final. It's like, come on, guys, just give me all the episodes. Apple TV Plus does that too. And I should have learned my lesson and just not watched it till all the episodes was out. Like, Mike, you told me to watch Black Rabbit. I watched Black Rabbit. All the episodes were there. It was great. So fantastic. And that's all right. So actually I have nothing new. I got nothing new. I'm interested in this book. Tobias Carlisle. He's a value investor. He's a manager on a couple ETFs, and they've got their own podcast called Value After Hours. But he wrote a book, Soldier of Fortune: Warren Buffett, Sun Tzu, and the Ancient Art of Risk Taking, that I'm going to check out and give that a look. And Morgan Housel has a new book out too called The Art of Spending Money. So I don't know exactly what that's about besides the title, but I kind of, he's done a good job with his books as well. So 2 books I have to somehow find time to read. And if I do, I will of course come back and let you know what I think. So, all right, guys, we did it. That's it. I will mention that while we still have some time until our prediction show, which is the end of December for 2026, I did predict in December of 24 that we would touch 7,000. Shane, what's the distance? What's the percent gain we need from here to get to 7,000 to touch it?
We're about 3%, which last time I checked could be done in a day.
Could be done in a day. Could be done in a day. Could be done in a couple days.
It's incredible. The more the S&P grows, it's almost a little bit psychologically throwing me off, because you're seeing such large moves in points, not equating necessarily to nearly as much percentage as it would have 2, 3, 5 years ago. So maybe we're going to just get bigger points, bigger swings. It'll be really interesting to see where we're at.
I mean, the points are not necessarily significant. I think mentally it is when you see up 50 versus up 100. I mean, I go back to March of 2009 when the market bottomed out, the Mark Haynes bottom from CNBC that he kind of called. It was in the 600s. So if you had a 50-point move when it's 600, I mean, that's a really different move than, it's 8.3% versus a 50-point move today is less than 1%. But I don't know. I'm still the camp that it touches there. Where it ends, I don't know. I don't know if it goes down first before it goes up, or if it takes another couple of years. Markets go up over time. So not really going on a limb saying at some point it will hit 7,000. But I don't know. I kind of think it hits 7,000 by the end of this year. Jane, you there or no?
Yeah, absolutely. I think you're seeing some chasing too from some of the people that, if you're a fund manager that's been sitting on the side since April, your clients probably aren't very happy with you. So I wonder if you're going to see some chasing. I wonder if you're going to see some people, going into year end with some strong conviction. Hey, we need to finish out 2025 strong. It seems like 7,000 is a very big number to everybody, again, psychologically. And yeah.
Mike, how about you?
Yeah, I saw something to piggyback off Shane. This is one of the worst years ever for active managers in terms of outperforming the index. Maybe we see some chasing there. It seems like it's heading to 7,000.
Okay. Which means it's probably going to 6,000 because we're all in agreement. So there you go. All right, everyone. Thanks for tuning in. We'll talk to you next week. See ya.